Well, good evening, everyone. It's obviously very nice to see you all, and can I just thank you all for coming to this evening's event, which is about the link between money growth and inflation in the 2020s. And in particular, it's about the role of the quantity theory of money. And you really do deserve thanks, as it's long been the practice to dismiss the quantity theory as unfashionable, outmoded, and irrelevant. So you're very brave to join us, we who very consciously are not members of the intellectual avant-garde. In the last few years, there was one top Bank of England official who was in the habit of deriding any discussions about money and inflation as coming from the Paleolithic era. And I suppose that's better than calling us dinosaurs, although in my career I've had that indignity too. Now, as Terence said, the Institute was set up 10 years ago, and the purpose was to keep the quantity theory, monetarism if you wish, in the public eye, largely by watching the regular monetary data, but also by contributing to the policy debate on macro policy issues and the research behind it. We're now into our 10th anniversary. So how do we go? So that's the first picture. And I've decided that I would give this year's lecture myself rather than inviting an outside speaker. It may seem rather self-indulgent, but I think it's justified. Some of the justification Terence has just explained, but the early years of the Institute were rather quiet as for macroeconomic conditions and inflation in the leading economies. But in early 2020, the situation changed dramatically. The COVID-19 medical emergency confronted policymakers with an altogether new and unexpected challenge. At the simplest level, COVID seemed to pose a massive negative shock to demand, output, and employment. So policymakers responded in most countries with a frenzy of expansionist measures. And at an early stage, the impact of the expansionist frenzy on the growth of the quantity of money was clear. So this is the growth rate of money for the whole OECD area as prepared by the OECD. And you can see the explosion in 2020. At the Institute, by the way, this was common to most of the big countries. Japan and Switzerland were partial exceptions. The Institute, the then director, Dr. Juan Castaneda, and myself reacted by forecasting a major inflation flare-up. By contrast, the overwhelming majority of economists in universities, central banks, finance ministries, international bodies like the OECD and the IMF, they said that COVID heralded a long period, perhaps a period potentially many years, of falling inflation and perhaps even deflation. And the disinflation view was without doubt the consensus of the profession in 2020 and for most of 2021 too. So we had here a very interesting test of theories, rival theories. The real world isn't like a laboratory, but the clarity of the test was rather like that of a laboratory, it's unusual in economics. And so the question is, who was right and who was wrong? Well, we were. Because in 2022, many countries, many developed countries, had the highest inflation for 40 years. Often these inflation rates approached or exceeded double digits, although interestingly, Japan and Switzerland were exceptions. So we were right, the professional consensus was wrong. And it seems to me that these events justify setting up the Institute 10 years ago, and they also provide the background and rationale for today's lecture. I'm not alone in saying that the profession's performance in this period was pretty bad. A chap called Jason Furman at Harvard, who was a top advisor to President Obama, wrote a blog in January 2022 lamenting economists' dismal performance and collective failure in not understanding what was going to happen to inflation. Now, in the next, I'm just going to set up my agenda. I'm worried that I'm going to not have enough time for all this, but because I do want Q&A, and I'm sure people want to ask questions. So, but let me just set out my agenda. I am, I'm afraid, going to inflict a few minutes of theory on you. It'll be the most painful part of the evening. You already know that I'm a monetarist, but what I want to do is tell you that there are different kinds of monetarism, and I'm going to suggest that Chicago School monetarism is actually dead. I don't regard what I do as dead, but I regard what I do as, I call it broad money monetarism. And it is, I suppose, become clear to me, it's a rather distinctive approach to these subjects. Now, any theory depends on evidence. So I'm going to spend some minutes on evidence from the United States of America and only the USA because I've only got so much time. So, I will. Then I'm going to, having stated my theory, presented some evidence, I'm going to remind my audience of what Juan and I said in spring and summer of 2020. Now, my loudest, well, I suppose, mine and that, but I'll be, sometimes you mind, sometimes it's mine, all right. My loudest inflation warnings were about USA, but we were also anxious about the Eurozone and the UK. Having done that, we're going to look in more detail at what's happened since the middle of 2020, because it's now over 4 years since then, so we can see how the forecasts have evolved and has the theory worked? Rather basic question. So, all right. Now, the fifth part of my lecture is going to be, well, some of you may regard it as funny, but, and indeed in some sense is rather funny. It's also rather unkind, because what I'm going to be doing is quoting from leading figures in the profession what they said in 2020 and early 2021 about the inflation prospect. And what I'm trying to get over to you is that, well, and this is controversial and it's my point of view, the profession is in a shocking mess. What's happened in this period should never have happened. It should not have been the case that just a handful of people, you know, a relatively, I'm sorry, Terence, but not a big university in Britain, and me working in the middle of Gloucestershire, should basically be able to get all this right, and the profession's been completely wrong. All right, so I want to get that over to you. The sixth part of my lecture is going to be about what's wrong with the theories that the bulk of the profession uses. And then finally, I'm going to give a sermon. Now, the sermon is going to be really about the guts of it is central bank's independence is, in my view, very much at stake, given the mistakes that have been made in the last 2 years. And so I want to talk a bit about that. Okay, so I said I was going to give you some theory. My approach to this is called broad money monetarism. Its origins really are, in fact, rather curiously with in interwar Cambridge, particularly with Alfred Marshall and Keynes. And I know Keynes is supposed to be the chap who destroyed quantitative theory and monetarism. Not really. I should just say that the label broad money monetarism is mine and not theirs. All the same, there's a lot of similarity in the basic thinking. To be precise, the key argument is that the equilibrium level of nominal national income depends on only two things. It depends on the quantity of money broadly defined, this is a critical point, broadly defined to include, at least in principle, all money balances, depends on that, and then the desired ratio of money to income held, where the money is held by private sector non-bank agents. Now, I know in this way of putting it, I'm relying a lot on these two words, equilibrium and desired. And what I'm going to show this evening is that quite certainly in the early 2020s, the amount of money that people and companies had, that agents had, was very different really from what they wanted to have. Anyway, in practice, people and companies often have got too much or too little money relative to the ratio they really want. And perhaps in the real world, economies are quite a long way from a sort of neat and simple, unchanging equilibrium. Now, I know these criticisms are valid. I concede their force. And it's certainly true in many business cycles that money holding agents have too much or too little money relative to the equilibrium. And that was certainly true in the 2020s. But by making these concessions, I think I've made us start to think. Suppose you've got too much or too little money in your bank account relative to what you'd like it to be. Obviously, you then take steps to change it. So how do agents adjust their spending and portfolio decisions if their money balance is not quite right, if they're too high or too low relative to income and wealth? Crucially, the economy has a transmission mechanism, a range of so-called real balance effects, which together constitute, in my view, the monetary transmission mechanism, which tends to eliminate disequilibrium and to bring the economy closer to equilibrium. And when I spend something on anything, money leaves my bank account. Of course it does. And a very natural thought is that it leaves my bank account and then it leaves the economy. In other words, individual decisions to transact in any goods or services, any asset, alter the total amount of money in the economy. Sorry, that's not true. The point is that when I spend money to buy something, money leaves my account and it goes into somebody else's bank account. All right? It goes to the bank account of the person who sold me the. The money from my account can then circulate an indefinitely large number of times. The adequate quantity of money is not changed by my purchase or by any subsequent transactions between non-bank private sector money holders. We're all moving our money around within a closed circuit. No matter how large the value of total transactions between money holders, purchase and sales between them don't change the quantity of money. That's a logical necessity. I hope, as I said, this bit of the lecture will probably be the most painful part, but that's really why I use broad money, because I've said that sometimes the economy has too much or too little money. We buy and sell things between ourselves. That can't change the quantity of money. So what changes? It's the total of spending, it's the total of incomes, it's the total value of national income and wealth. Therefore, it is that measure of money which can't be changed by these transactions that is causing movements in income and wealth. In short, our discussion, a little cameo, explains how excess or deficient money causes changes in expenditure behavior, which take the economy back towards equilibrium. Notice that the quantity of money at work here is determining national income in the analysis. National income adjusts to broad money, not the other way around. It may all seem less obvious than it seems, but that is, in a sense, rather obvious. In my view, it is fundamental, and I'll now, in the next few minutes, explain why. In the real world, we talk about broad money normally in terms of M3 or M4. They're always the measures of money I look at. In this episode in the USA, that's what I was always looking at. If that is the measure of money that includes all money balances, it can't be changed by changes in the relative size of its components. The total is the sum of its components. The components change, the total won't change. And that too is logically necessary. And that's why I never look at narrow money. I never look at narrow money or the monetary base. I never look at narrow money because suppose that this, I think, just to give a very simple example, the total of all money out there is kind of current accounts, don't pay any interest, and deposit accounts that do. Suppose that there's a change in the rate of interest, where the rate of interest falls, then there'll be some movement of money from the deposits into the current accounts. That'll cause a jump in M1. No, that's not going to then affect the economy because it's a response to changes in the relative attractions of different kinds of money balance. More generally, I would say that narrow money adjusts to the economy, not the other way around. All right? So, in my view, M1 may legitimately be understood as an aggregate determined by levels of expenditure and income. Narrow money adjusts to national income, not the other way around. And haven't got time now, but I think a similar argument made about the monetary base. So I never look, when I'm making these, I think a lot of you here follow what I write every month. I never look at narrow money or the monetary base. I always look at broad money, and that's the reason why. This has really been the distinctive bit of my contribution to the UK public debate really for 45 years or so now. Now, I should just say here that the debates I've had haven't just been with, if you wish, the other side, the Keynesians. I've also looked at debates with people who suppose call themselves monetarists, who are very much into narrow money and the monetary base. And let me make absolutely clear that I want to get myself distanced from them. Okay? I have nothing to do with that. In this period of 40, 50 years, there's been a kind of monetarist civil war, with the battle of the aggregates by far its most prominent encounter. Now, ladies and gentlemen, you'll be aware that there were two factions in the nation of Lilliput. The big Indians who broke their boiled eggs big end, rebelled against the king. They rebelled because the king had demanded that his subjects break their eggs at the little end. It's all in Jonathan Swift, if you're wondering where it comes from. And some years ago, the late Anthony Harris, a columnist on the Financial Times, compared this monetarist battle of the aggregates to the Swift satire on the big Indians against the little Indians. And you might chuckle about that. No, sorry, this is absolutely fundamental. And let me now explain in just a few examples why this really does matter fundamentally. In the 1980s, I had a debate, largely with Patrick Minford, about what was going to happen to the economy because of a then boom in bank credit. I said that the growth of bank credit would lead to rapid growth of broad money, which it did, and this would then be followed by a boom and a rise in inflation, which duly happened. I'm afraid I was right and Patrick Minford was wrong. What happened in those years was not unconnected with the end of the Thatcher premiership in 1990, when the inflation rate was last in double digits. So one example where Patrick was using the M0 measure of the base, basically, to guide himself in this episode. Roughly the same time in the USA, Friedman made a catastrophic blooper. Blooper was actually his word, in correspondence with David Laidlaw. Because he forecast that there was going to be a return of high inflation in the USA in the mid-1980s because of the behavior of M1. Essentially, interest rates fell very heavily in 81, 82, 83. Exactly what I just talked about happened. There was a big movement away from interest-bearing deposits into the sight accounts. M1 soared. Friedman said there'd be more inflation. It's completely wrong. And this, again, was deeply embarrassing because this was Milton Friedman, for heaven's sake. A mistake arose from using M1. Let's then fast forward to the sequel to the Great Recession. In 2010, 4 fellows of the Hoover Institution signed an open letter to Ben Bernanke with the warning that the Federal Reserve's asset purchases from late 2008 would cause currency debasement, inflation. Well, nothing of the sort happened. They were using the monetary base, which at the time was soaring, to make their forecast, again, using the base was completely wrong. On this side of the Atlantic, Liam Halligan, newspaper columnist, used the pages of the Sunday Telegraph to criticize me, bless him, for my then view that UK's quantitative easing program, the asset purchases, would not lead to rapid inflation. The reason was that banks were shrinking their risk assets, their loan books, and so the QE was simply replacing that, and overall broad money growth was very low. Again, I was right, and Halligan was wrong. So this apparently rather technical discussion about which measure of which aggregate is correct is absolutely fundamental, and I've tried to explain. I'm sorry, this has been, if you like, the perhaps rather painful part of the talk. I tried to explain why I believe what I believe in this area of economics. As I say, in my view, Chicago School monetarism, which is very much about the base and narrow money, is more or less dead. And one of the aspects of that I want to highlight is there were nothing like, I just say what Juan and I said in 2020 was terribly clear and it wasn't, no reservations, qualifications, and so on. There was nothing like that on the other side of the Atlantic, despite what was going on there. Okay, so having just this one aggregate makes life in some ways much easier. And so I think what I want to do, I'll just, hang on. So I'm going to try and, am I going for time? All right, I think. Am I right for time? I want to say one thing about the transmission mechanism, that in my work, I tend to focus on not just the link between money and spent money on the one hand and spending and incomes on the other. I also look about the relationship between money and asset prices. And something I highlight very much is that when you get too much money in the economy, typically the first prices to move are asset prices. And by that, I mean prices of corporate equity and property, meaning both residential and commercial property. Typically, asset prices move before the prices of goods and services. Too much money chases too few assets, and then afterwards you get too much money chasing too few goods and services. And that's a very important part of how all this works. In the long run, I would argue that there's the so-called proportionality postulate works more or less. And if you get a 10% jump in the quantity of money, that implies a 10% increase in nominal national income, but also a 10% increase in value of equities and the value of houses, buildings, and land. Okay. This aspect of my work is very important when economists are advising officialdom, government and central banks, but also, of course, corporate clients and investors in the private sector. Okay, so that's rather quickly in a rather hurried way, my theory. I've now got 40 or so slides to get through, and it's already actually about 7 o'clock. So I think I'll have to move very, very quickly. This is my first picture. This is the changes in money and nominal GDP in the USA in the century from 19. The Open Market Committee had been interested in this subject in 2020. This is what they would have seen. They would have seen that in this period, the quantity of money rose on average by about 0.5% a year more than nominal national income. Of course, there were some occasions when the gap between money and nominal national income was pretty large, but nevertheless, over the whole period, it was only 0.5% a year. Let's then look at this picture. This is the ratio, well, strictly. There's the ratio of money to national income, or there's the amount that money turns around, and that's called the velocity of circulation. And you can see that in this period, it's gone down from 2 back in 1918 to about 1 a few years ago. Money rose faster than national income, and so it moved around more slowly. The next picture is really absolutely fundamental to the way I think and the kind of forecasts I then produced with one in 2020. This is the annual changes in that velocity picture I just shown you. You can see that the average change in velocity is not quite zero because the ratio of money to GDP changed. But what I want you to notice is the way in which, when there's a great surge in the change in velocity, there's an offsetting collapse in the next few years, or maybe even a year later. And this series has the technical property of what's called stationarity. It reverts to its mean value, which is only about half percent a year change. Ladies and gentlemen, I've just gone through a century of data. I've shown you that in this period, the change in money has been a bit different from that in nominal national income, but not very much. And also I've shown you that when you get a big rise or fall in velocity, you tend to get an offsetting movement in the opposite direction in the next few years. That's what this meaning of what mean reversion implies. Suppose that you were then in spring and summer of 2020 involved with setting of policy in the United States of America. Yes, there is obviously COVID and damaged livelihoods and a lot of uncertainties and the rest of it. But there have been other epidemics, and usually after, there was an epidemic after the First World War, Spanish flu, which killed millions of people. And humanity tends to get over these things within 2 or 3 years. So it was really known, say from April, May 2020, that there would be dates out there in the planning horizon when basically it would be over. And they wouldn't be that far away. I mean, I conjectured late 2021, but anyway. Would you, knowing this, knowing the last, could you imagine the quantity of money in the USA rising by over 20% at any time? I put it to you that it's pretty implausible that anything like that would ever possibly, could even in a nation like the United States, could even happen. And let's just look at this chart. Do we see any, look at the numbers from, say, 1945, more stable after the Second World War. You can't see any increase in broad money, an annual rate of over 20%, can you? All right. Anyway, so now then. It was COVID, and it was I don't remember then, but there was some lovely weather. Spring 2020 was glorious weather in England. And of course, right about the world coming to an end, but it was in some ways it's a rather curious time. My family and I was marooned in rural Gloucestershire because of lockdowns. I still had access to the internet. I could watch my favorite news items, which of course press releases from central banks with monetary data. As I said at the start, the lockdown saw a frenzy of expansionist measures. Budget deficits widened, central banks indicated their preparedness to finance deficits on their own balance sheets, and most central banks also purchased assets on a big scale. The growth of broad money exploded. Now, the Federal Reserve publishes a weekly press release, H8 press release, comes out in the UK Friday evenings. It's obviously part of my standard reading. It shows the assets and liabilities of US commercial banks, including the figure for deposits. And deposits are most of broad money. So late March and early April, these releases told me, this is in darkest Gloucestershire, an amazing story. As I said, bank deposits are the main component of broad money. for about a month at that time, the H8 release showed deposits going up by 1%, 1.5% a week, 1.5% a week. And in fact, there were some weeks that went up by about 2.5%. So sorry, I'm slightly out of turn. This is the numbers on decade by decade of money growth and nominal GDP growth in the USA. If you knew these numbers, would you ever imagine that policymakers there could engineer a 20% increase in the quantity of money? Here is, as I said, what I was looking at in late March, early April 2020. The growth of deposits in this period was, if you annualize them, at rates at up to 90, 100%. Eventually, the figure did come out for April 2020, with broad money rose in the 1 month by 7.4%. Ladies and gentlemen, there had not been 1 year in the 2010s in the USA when it rose by as much as that. It went up by 7.4% in 1 week. And this then carried on with these numbers, not quite at this intensity, but this carried on until the end of July. And in the period from the end of February to the end of July, US broad money rose by almost 20%. The increase in US broad money in the year to June 2020 was in fact 25%. It was the highest since 1943. Now, Juan and I moved into action. In fact, we moved into overdrive, and we started to produce lots of warnings about all this. May I just say at this point that I'd like to thank Charles Goodhart for being in touch with us at that time. I think I sent out my first warning on 23rd of March. Charles wrote a piece on 27th of March talking about the possibility of double-digit inflation in the UK. I was more concerned about the US. And Charles, in fact, gave the Institute's first public lecture a few years ago. So we're very grateful to Charles for that. But that was about it. And anyway, so I'll just run through quickly these. This is something I said on the 30th of March. Given that money and nominal GDP do track each other over time, I just showed you that. All right, that's this, and also the previous pictures. Given that they do track, it seemed plausible, but also might be 5% at some point next year. But given what had happened just in 1 week, actually, at the end of March in 2020, that was actually too conservative. And I said that inflation in the USA would move to between 5 and 10%, which of course is what happened. I did expect this period to be very exceptional, and it was. But in 2021, there was again rather high money growth. So over the 2 years together, there was really an explosion in the US money supply. Of course, the variation of money to GDP does change, but when you take the medium term, it tends to even out. Okay, and that's the point of this mean reversion of the change in velocity. All right. So unless, it wasn't very likely, it didn't happen, unless the money injection was withdrawn, the prospect was therefore for a serious inflation flare-up. Now, I'm going to have to move on very, very quickly because we're running out of time, and I'm sorry I haven't judged this very, very well. I would just say that in the year to the middle of 2020, this is something slides I exchanged with Juan, the quantity of money held by American companies rose by 40%. All right. I'm going to come on to that in a second. This is the Eurozone. Eurozone money growth peaked at 12.5%. In the UK, it peaked at 15%. Not quite as high as in the US, but these numbers are all Same kind of analysis that I've done for the US can be done for the Eurozone and the UK. This is an exchange comments on something Andrew Bailey said. This is, you can read it. Bailey, this is me talking I've known various bank governors. The rate of increase in UK price level depends on the rate of increase in money relative to the rate of increase in goods and services. And I will be surprised if the things that they were then doing do not lead to an inflation rate, M4 increase of double digits in inflation rate close to 10% we've seen for many years. This was the 6th of April 2020. It took basically to November 2021 for Andrew Bailey to realize that this was actually what was going on. I'm afraid that's... I then repeated this in early 2021 in the House of Lords evidence. Japan was different. Japan, the peak of the annual rate of growth was about 8%. They haven't done anything like the inflation that other countries have had in this period. Now then, I'm going to have to move, I think, because we really want to. I'm going to just talk about the US and then I won't cover the Eurozone and UK because we're going to be so short of time. This is the quantity of money soared by about 20% in spring and summer of 2020, just that 5 months to July. Nominal GDP went down, so the ratio of money to GDP soared and the velocity collapsed. All right, you'll notice the stability until 2020. Essentially, what I was saying was that over the next 3 or 4 years, that would bounce back to the kind of numbers seen in the 2010s. And assuming that there was still positive money growth, there had to be lots of inflation. All right. So that's actually what's happened in the USA since then. So the bottom point is the end of the second quarter 2020. The final value is the end of the second quarter 2024. There has been a lot of inflation, as you know. It's now come to an end. In fact, what happened to the money growth numbers was that from early kind of February, March 2022, money growth in the USA came to a complete halt. I didn't expect that, but that's what happened. And that's contributed to this reversion to mean of the velocity numbers. This is the numbers for nominal GDP and broad money in the USA since over that 4-year period. There is only 1 quarter in which nominal national income grew more slowly than money. Just see that 2021. Otherwise, every single quarter velocity increased. Now, this is, however, the USA, Eurozone, and the UK. I've given you the values of velocity in the middle of 2020 and then what they are today, well, the end of the second quarter 2024. And I want you to notice the change in velocity in those in 1 year periods. There's 4 years in these 3 quite important areas. In every single case, velocity increased. You could hardly imagine a clearer confirmation of the basic correctness of the conjecture I made with one or two other people, not many, back in the middle of 2020. Now then, my profession. And I'm going to have to stop quite soon because we do want, I think, some Q&A. So I'm going to just, I think, have just one picture. There's a lot more here, actually, but I'm afraid I'm going to have one more picture. And it's this guy. I'll have a few more. This is Paul Krugman, and he's often regarded as the world's most influential economist. Now, in spring 2021, there are still some people in the USA who are interested in money and inflation. Of course, they're jumping up and down. Some of them were. And so, anyway, this is what he did in his column. He said, this idea of a link between money and inflation, there are these different ideas. There's zombie ideas. eating people's brains, and the much worse cockroach ideas, which have, despite their falsity, always come back. And so he said that monetary claim of connection between money and inflation was, according to Krugman, nearly a cockroach idea. And he then, the emerging buzz about the subject was evidence of an infestation of monetary cockroaches. Well, you can see a monetary cockroach before you now, and I do, this is a photo opportunity, so this chap is a Nobel laureate. No. One of his chums is a chap called Olivier Blanchard. Olivier Blanchard was chief economist at the IMF for 7 or 8 years. And this is what he said in April 2020. This is when I was in Gloucestershire looking at these weekly H8 press releases showing these fantastic growth rates of money. And okay. The challenge for monetary and fiscal policy is thus likely to be sustained demand and deflation, to avoid deflation rather than the reverse. And we had, this is a chap, this is Richard Florida, who at the time was vice chair of the US Federal Reserve, in a sense, the most senior economist at the Federal Reserve. And he said that COVID-19 was going to be disinflationary, not just in the next few months, but over the next few years, presumably out to 2023 and 2024. I'm not going to have time to go through this, except that, look, Jay Powell is a very clever guy. You know, he's made a large fortune, and he's a private equity. He knows corporate balance sheets, for heaven's sake. He wouldn't have made it, didn't have to. Did he know that the quantity of money in US company balance sheets had gone up by 40% in the middle of 2020? This is what he said in a press conference in the questioner at this press conference was, this is after the Federal Open Market Committee meetings. None of the forecasts coming from the FOMC in September 2020 had an inflation rate for 2021 and 2022 above 2%. I'm not making that up, that's true. So he was asked, why in your forecast produced by the FOMC are none of the forecasts above 2% when you're supposed to have brought in this new regime that's going to cause inflation to go through 2%? And this is what he said. You know, we know all these things, don't we, about inflation dynamics in the United States and around the world. Knowing that, we expect the economy will recover quickly now, but then the pace will slow and there'll be a big area of slack and so on. And the FOMC forecast for inflation will be under 2% through 2021 and 2022. It's September 2020. This is a guy who, for God's sake, knows what a company balance sheet's all about, and presumably somebody should have told him that there'd been this this huge jump in company bank deposits in the year to the middle of 2020. All right. And then finally, because this is not to be, it's not all on the other side of the Atlantic. This is a lady called Isabel Schnabel of the ECB, and I'll leave you to read that. But again, the ECB was expecting zero inflation, possibly worried about disinflation out to 2021 and 2022. But look, there's a huge mass of other stuff I've done. It's all brilliant. It's all very eloquent, but I'm going to shut up now because I've taken up too much time already. And we're going to invite questions from the audience. I really have to tell you, and this is really the main point I want to get over this evening, is the profession of macroeconomists is in a shambles. And the wider problem here is really the respect or loss of respect for central banks because of this episode. If another one's like it, then there really is a problem. And I'm just going to run through, I'm afraid, the last ghastly picture that I've got here, which is this one. You know, I think it's pretty plausible that this guy, who I deplore, is going to get Powell out. What he's going to do, I don't know. But it's very clear that the Fed's independence is threatened in a way that hasn't been the case for decades. And the failure to forecast inflation in this episode is a large part of the problem. And I'm afraid that the profession basically has let American public life down, other countries too, dreadfully through this failure. Thank you.